given everything that's been going on, I'd say you sounded, not pessimistic, not optimistic, but kind of neutral.
Yeah.
And you've made some changes to your outlook for equities and fixed income, which sound to me optimistic.
Yeah, we actually are more optimistic about stocks today than we would have been, say, 6 or 12 months ago. Which you're right. There's a lot of things going on in the world. There's a lot of things to worry about. But there's really three things that make us more optimistic. And the first thing is valuations. It's the old thing, when prices go down, do you want to buy more or do you want to buy less? If your price of your house goes down, you
good time to buy.
Good time to buy. So stocks have gone down. All markets went down last year, and some markets, take Canada, emerging markets, they've really been going down for 2 years or more.
And the U.S. really took it on the chin.
The U.S. took it on the chin, particularly in the fourth quarter. And so if we look at the valuations in the United States, say 15 times earnings, in Canada 13 times earnings, some emerging markets are trading high single-digit sort of multiples. In a lot of cases, dividend yields that are higher than bond yields, companies generating very strong cash flow. So I think the valuation environment just implies that slower growth, which is going to happen, is already discounted in today's stocks. So I think that's a key reason we're more optimistic. Second one would be just right back to what we were talking about before, which is central banks. They were hiking. We think they're going to stop hiking.
Yep.
And so if we get interest rates stabilizing in this 2 to 3% area, that should support reasonable valuations for stocks. As I said, you got a lot of stocks where dividend yields are higher than bond yields, and in this environment, 13, 14, 15 times earnings doesn't look that bad against the 3% bond yield. So that's the second thing, and the third thing is just our view that we're not going to get recession. If we get a recession, stocks will go down. Our view is we won't get a recession. We'll just get this kind of slowdown. And then stocks take a bit of a breather and they start to go up again, as they tend to do over very long periods of time.
We've got a chart here we can show, and so how this is manifested for you is, I believe you had, when you looked at equities and fixed income, you had a neutral outlook.
That's right.
On the overall categories. You've essentially split them in two directions. We've got equities here first, which we can see you've moved to overweight, modestly
That's
overweight.
Right.
Is
That's
that
right.
Yeah. So, and let's just run through everything else we hear. So equities overall, modestly overweight. Canadian equities?
Yeah, we're sort of in the middle on Canadian equities. It's not our favorite market, and stocks in Canada are very cheap. There's no issue about that. But we know there's a lot of things overhanging, and the two big ones from our perspective are quite high household debt, which probably will slow economic growth. And the other is this whole debate that's happening in the energy sector, the challenge we have in getting pipelines built. And that is really casting a pall over Canada from an international investor perspective. And so we're just not getting a lot of inflows into our market from outside. And I think there's a good chance we won't until there's a bit more clarity on how we're going to drive economic growth in the country.
U.S. equities, you also have, I think it's here, the modestly overweight. Is this, again, a valuation driven?
Well, we've been overweight the U.S. The U.S. has been our favorite market for some time. So that
hasn't changed.
That hasn't changed.
Yeah.
We continue to like it. Strong technology component. The U.S. economy, although slowing, is still, I think, the strongest of the major markets in the world. Very diversified market, companies generating great cash flow. Continue to like it. And
international equities, I don't believe you changed that. You
nope.
are
modestly
We're
still more cautious.
Overweight.
So the biggest component of international equities is Europe. Slow growth. Political challenges continue. Obviously, a lot of focus on Brexit. The one I worry about just as much, I'll say, is Italy. You've got very high debt and very low growth, which is a bit of a toxic combination. And I think there's still this kind of existential debate within Europe about the euro, and can you have all these countries existing within one currency zone? So we're just a bit more cautious there.
And emerging market, you're a little more optimistic.
Yeah, emerging markets,
where
we've historically been more cautious, but those markets have been very poor in the last couple of years, and valuations, I think, are quite attractive. And you could have China. I talked about the fact that growth was slower, but the Chinese government continues to provide stimulus, and so you could see an environment where growth actually improves in the emerging world which combined with the relatively low valuations could be a bit of a catalyst.
Let me ask you, I'm not going to spend as much time on the fixed here, but we'll bring this up. You've gone, again, from neutral overall in fixed to modestly underweight.
Yeah.
And I know it looks as though you've gone a little more optimistic or overweight on investment grade corporate bonds, high yield bonds, basically the riskier types of bonds.
So it's consistent with the view on equities. We're a little more, we think you're getting paid to take risk in this environment, whereas government bonds we downgraded. Look, it's just a reflection of the fact that yields are relatively low. Yields on bonds government bonds are kind of in that 2 to 3% zone. They can provide stability to a portfolio, a modest amount of income, but you're not going to make much money. Spreads on something like high yield have blown out quite a bit in the last, say, 3-4 months. And the yield on high yield, you're getting into that kind of mid to upper single digits, say, 7%, that kind of zone, which is actually, we think, quite attractive if you pick the right high yield securities.
Yes.
Which is, you really want to, in many cases, have a professional do that for you.
Yeah.
It's a pretty complex area.
Yeah, active management has gotten, it's even more active than it used to be, I think.
Yep.
Final question for you. We've only got about a minute here, but for someone who's watching, it was not a good time to be watching the markets in December. So, when people are kind of, getting their statements or opening things up, I mean, how should they be digesting what's going on right now? Yeah,
so last year was a tough year. Most asset classes were either down or had modest performance. But investing is a long-term game, and the most important variable is the price you pay for something. I think the price you're paying for assets now is more attractive than it was, say, a year or two ago. I think people should stick with it for the long term. We always tell people, focus on quality assets. It's not a time to speculate. This is a time to focus on stocks that pay good dividends, grow their dividends over time, protect you from inflation. And that kind of solid, steady Eddie approach will serve you well. But we think more attractive today than it would have been a year ago.
Bruce, always a pleasure. Thanks so much.
Nice to be here.